Old Mutual says the global market is grappling with an array of challenges, notably the escalating trade tensions. This will likely further slow global economic growth prospects and those of South Africa. Old Mutual believes the market is underestimating tariffs more than it should be, emphasizing the disconnect between perceived stability and actual risks.
There's clearly a lot of uncertainty in global markets. Investors aren't sure that they understand the full impact of tariffs yet, and I think that the data hasn't really come out in terms of the hard data. So our view is that global growth will start to slow. US will particularly be quite slow, and that naturally has a spillover effect into other economies. In South Africa will be exposed to that slowdown. I do think that we've got some domestic tailwinds that'll help us support our growth, and there are some reforms and monetary policy relief that we could get. But generally, we are quite worried that there is an imminent slowdown globally, and that's the type of risk that we are watching out for.
The Financial Services Group says that despite the uncertainties, opportunities exist. It says the current environment favors growth assets, particularly in sectors like mining, which are benefiting from strong commodity prices. The platinum group metal sector is seeing a resurgence due to the supply challenges and a slower than expected transition to electric vehicles globally.
There seems to be a little bit of economic reality starting to set in about the cost of moving to electric vehicles. So again, doing a bit of digging into the underlying company data, we've just aggregated a few of the EU auto producers, so VW, BMW, etc., Stellantis, and you can see versus BYD, right? BYD, the Chinese EV producer. You can see up to now, those traditional ICE vehicles are actually quite supportive of margins, and the electric car industry is producing at quite lower margins.
With South Africa engaged in discussions about lowering the inflation target from the current 3 to 6% bracket, Old Mutual says that while this could be beneficial in the long term, there could be pains in the short term.
The concept of having a lower inflation target is great because it benefits the fiscal position in terms of paying off interest rates. Unfortunately, what it does mean is that inflation needs to come lower. And that's really difficult to predict. If inflation doesn't come lower, it means that the Monetary Policy Committee will have to keep interest rates fairly high. And because our economy, we're not in a great shape at the moment. GDP growth is about 1%. And if there isn't any interest rate relief in the next while, that could hurt our economic growth prospects. So that is one thing that we are concerned about, is that over the short term, we might have some softness in data, specifically if MPC doesn't actually reduce rates, given what inflation does. And that for us is probably one of the biggest risks of lowering your inflation target over the short term.
Old Mutual believes the Reserve Bank's Monetary Policy Committee could possibly cut rates by 25 basis points at its next meeting next week. Gloria Sefako Musi, SABC News, Johannesburg.